Good morning or good afternoon, depending on what part of the country you're in. This is Rick Geiler with SilverSide Insurance Marketing here in Arizona. And we have a special presentation for you, an exclusive agreement that SilverSide and Asset Management Strategies have worked out to allow agents to offer professional money management to their clients without using a securities license of their own. And we'll get into a little detail on exactly how that works and exactly the approach to managing the money. I have on the line with me today Tony Fiorillo from Indianapolis, Indiana. He is the founder and CEO of Asset Management Strategies, and he's got a presentation for us. Let me remind everybody, you are in listen-only mode on today's webinar. If you have any questions, go ahead and type them into the question chat you'll see on the bottom right of your control panel. And we've also included a few handouts for you that are going to color up a little of the detail on today's presentation, including a bio on Tony, some frequently asked questions on this exclusive program, and a strategy piece on the strategy AMS implements towards managing some of the money. So without further ado, I will go ahead and turn control over to Tony here. Tony, are you with us?
I am. Thank you, Rick.
Okay. Hey, welcome, and thanks for being aboard. And I will go ahead and turn the webinar over to you, and you can get started. Again, anybody, if you have questions, go ahead and type them in. We probably will save question and answer period for the end.
Thank you, Rick. I appreciate the opportunity to speak to your audience today. We're excited about this opportunity to offer this to the agents, and I think a lot of people are not familiar with the concept of what is called a solicitation agreement, but agents in some cases would like to be able to offer fee-based asset management, but they may not be licensed, or they may have issues with their licensing that they would like to avoid. So, if your current status is that you're not securities licensed, either 65 or 6 or 7, we can still do a solicitation agreement. Or you might be in a situation where you are licensed, but you're not as active as you might be, and your business is predominantly, on the insurance side, and depending on what level of business that you're doing on the security side, it's more of a nuisance than an advantage to you. You could have compliance issues. Whenever you're with a broker-dealer, you have significantly higher compliance regulations than when you are with a registered investment advisor. For example, if you have a broker-dealer affiliation, you cannot do a solicitation agreement. A solicitation agreement is only for fee-based people, so it's only under the RIA. So you may have irreconcilable differences with your broker-dealer, where they are increasingly more difficult to be a good match for your business, and you see that in the way of more compliance, more administrative cost. Could be that they keep shoving more and more of the fees out to you. I know that I was with an independent broker-dealer for many years, and at the end of the day, what I looked at as my 1099 never came close to what the stated payout was, and it was all the fees that kept tacking on there. So, the other issue currently, topically, is a source of funds concern. A lot of states are being very aggressive at bringing action against insurance agents if they are making a recommendation that somebody sell a security in order to put that money into a non-security insurance product. A lot of states are deeming that to be a securities recommendation, and that can be very dangerous. So we think that this is a workaround. We have the capability to make that recommendation on your behalf. If you have a client that you need to talk to, we're happy to get on the phone and make that recommendation. We also have, this is too big of a topic for today's call, but with the new DOL fiduciary standard, there are major concerns, and I think everybody's life is going to be dramatically different going forward because of this rule, unless somehow it gets overturned or postponed. But in this Department of Labor fiduciary rule, there is an exemption for flat fee charges. So the flat fee exemption says that as long as we're charging a flat fee to our clients, significantly reduces the impact of the fiduciary rules. So we can talk more about that later, but I think that we do have a solution, and we do have a way to work through that. So what we offer is a fee-based management, and we pay a referral fee to the agent that introduces us to that client. Some people are not familiar with these solicitation rules, so we put this long verbiage here, and I apologize for that, but I did want to show you the actual code from the Advisors Act. This is a link to the SEC website, so you can see it straight from the horse's mouth. But I don't know how many people are familiar with the solicitation agreement. If you could, in the chat, just respond yes or no if you had prior knowledge to the solicitation rule. We're kind of curious to see how many people knew about this beforehand and how many people are hearing it today for the first time, to see how much we need to address the issues here. Quite frankly, there are some people that have said, I don't believe we can do this. I don't believe that it's legal for you to pay us a referral fee. And if you read through this, it pretty much says that it is prohibited unless you do the following. And number one is we have to have a written agreement between the advisor and the solicitor, which is just an agreement stating the terms of what we're doing. Number two, at the time of solicitation, you have to provide the client with a copy of our brochure, our AD, we will provide to you to give to the client, and a written acknowledgement that the client knows that you're being compensated. I think that that can be portrayed in a very positive light, because people want to know that there's more than just them involved in this decision. They want to hear that the advisor, the insurance agent, has done some due diligence, that this isn't the first time this question has come up, and they found a solution to satisfy that portion of their business, and they've aligned with this firm to do that. The third thing is that they have to receive from the client, a copy of that written statement that just says that they're aware of that. And I think it's important, too, to disclose to those clients that our management fee is no more because we have this referral relationship with the agent. And I think that as long as the client looks at that and says, we're not paying any addition, I'm thrilled to have you in the loop, because now I've got somebody else that's looking over, the activity to say if I'm still doing the right thing or not. Yeah, we are a registered investment advisor, and in today's call, we want to be respectful of your time, so we don't want to get too much into our investment management strategy. But we do have a fact sheet that is included in the handouts that shows our recent performance. Basically, we have on our equity portfolio, we have a 13-year track record, and that track record shows a return of just under 10%. Gross of fees, and more importantly, it does it with about 2/3 of the risk of the overall stock market. So we think that this management style is a great complement to, especially index annuity. I think annuity buyers, in the most part, are very naturally risk averse, or they wouldn't be having that conversation to begin with. But if they do want something that has the potential to give them better returns and is perfectly liquid, we think that this is a great complement to that. So in no way do we expect this to be a replacement for index annuities or your annuity activity. We think that this should be a complement, and at the end of the day, it should get you in front of bigger clients. You should see bigger activity. Your average annuity sales should go up, and you should be able to increase annuity sales along with this. Our strategy is really what they call trend following. We construct the portfolio with exchange-traded funds, and those exchange-traded funds are, for the most part, major asset class funds. So we keep the internal cost as low as we possibly can. Our maximum management fee is 1.5%. I don't know if you've seen some of these other programs similar to what we use. I've seen fees of 2 3/4, and they don't cover the trading cost. for 1.5% maximum fee, we cover all of the trading costs. So at the end of the day, with our internal operating expenses at somewhere between 2 and 0.3% plus our management fee, the total cost to the client is going to be about 1.7, 1.8%, and that is actually less than the average no-load mutual fund operating expenses and trading and brokerage costs. So I think it's a very good value proposition. We want to be cost conscious, but at the same time, we have a good enough track record where we can justify adding a premium. If somebody said, well, you're more expensive than if I just bought mutual funds that were all index funds, that's very true, but we think that our value add is not just in the selection and the cost cutting of the construction of the portfolio, but the actual management of the portfolio. We do employ a trend following strategy that we look at the price movement of these assets on a weekly basis. It's not a very actively traded function. We may have 6 to 8 trades a year, and we will never short the market. So if all of our red lights go off, if everything looks bad, we will go to cash, and we will sit there for as long as we have to, gaining as much safe short-term interest as we can, waiting for the markets to kind of regain their footing. So we think with this strategy, what it will, the advantage that it will bring to you is that you should be seeing significantly more substantial clients. Higher net worth people typically have their money managed this way. This is very much kind of a white glove service that a lot of firms like ours have a minimum of $500,000 or $1 million. We have no minimum. So we think that this will avail you to see bigger clients. I think the fact that you have more options to present to them, that one of those is perfectly liquid, that should help you establish trust a lot faster. You're not just selling one illiquid investment. We think that it's an easier sale because it is liquid. We hold the accounts at Fidelity. They access their account through Fidelity.com. There is no surrender period. There is no time period that they're committing to. There is no upfront charge to them to get this started. I don't know that we've ever had a client that didn't stay with us for at least 3 years. So we don't have people that join us and then leave. I'd say our average client has been with us for about 14 years. So because it's liquid doesn't mean that the people jump in and jump out. They tend to be very loyal because of the strategy that we employ. Again, we think that the way that we manage money is an excellent argument to go along with index annuities. It's certainly not a replacement for that, but the way we look at it, the index annuity should be probably the fixed income portion of their allocation. So it's a lot easier to say to a client that has $1 million of investable assets, I think you should put a third of it into this index annuity where you never have to worry about the principal. There's nothing that can affect you that can reduce the principal. There's no headline that can affect your ability to retain 100% of your principal there. It's just a question of what you'll make. And then you have 2/3 of your money that is liquid and earning potentially higher returns over a long period of time. You don't have to have any kind of a securities license in order for us to pay you under the solicitation agreement. You don't have to have a Series 6. You don't have to have a Series 7. You don't even have to have the Series 65. I know that there are other programs out there that are telling insurance agents that they absolutely must get a 65 because of the source of funds issues that are coming, and I think that argument is getting stronger and stronger. But I don't know that you necessarily have to have a 65 if you're working under a solicitation agreement. Yeah, I mentioned the contractual agreement, which is just states out the terms. It's a written agreement. We disclose everything to the client. Keep in mind too, this is a recurring income stream. So I've done a little bit of a spreadsheet here to show you what could be possible over a couple-year period, and this is with some set assumptions. But if you added $3 million a year to the assets under management, and those returns averaged 8%, and they were at our maximum management fee of 1.5%. then the referral fee to you in the first year would be $15,000. If you added the same number of assets over the years, that number starts to build. And if you look down here in the fifth to sixth year, you've literally built yourself an annuity of $100,000. And we will continue to pay that referral fee on that management fee as long as that client is still a client of ours. And we want to be careful that you know what you're allowed to say and what you're not allowed to say. The most important thing that you're not allowed to say is that you are managing the money, that you are securities licensed and capable to do this. Pretty much anything else is fair game. We'll give you a list of scripts and approved things that you can say, things that you want to be careful not to say. We'll support you with the website that has a lot of scripts that give you suggestions on how to present. We'll have regular webinars to support you. We will do individual calls if you have a client that wants to speak with us directly or to make a decision. We're happy to do those calls. We'll do regular conference calls so that if you have a number of people that you want us to talk with, we might be able to do that in one conference call. We can do in-person meetings. I want to be careful to say that we can't be spread too thin, but if we have, a geographic area of the country where people are doing a lot of business, it's in our best interest to get out there and host an open house and meet these people face to face. So we're not afraid to do that. We just want to be careful that we're not doing it just to meet with one potential prospective client. As I said, we use Fidelity Investments. We are the advisor on the account, so everything is very transparent. The statements that they get come directly from Fidelity. If they add money to the account, the check is made out to Fidelity Investments, not to my firm. If they need money out of their account, the check comes from Fidelity Investments. We can set these accounts up so that they get a regular monthly payment. We can have their local bank account tied to these accounts, so the money movement is very simple and efficient and safe for the clients. So if you're interested and you want to sign up, a couple things that we need to do. First, contact SilverSide to get started. Then I think we need to have a deeper conversation about exactly what our investment strategy is. I think that we're kind of glossing over that portion of it just to say this is the concept, and if you're interested in the concept, then let's really get you comfortable with the way that we manage money. You have to be comfortable and confident in the way that we manage money, or you're probably not likely to recommend it to your clients. I shouldn't say recommend to your clients, introduce it to your clients. We would have to have a signed agreement, which I spoke about. We want to be helpful as far as the marketing plan. We think that if you haven't had experience talking to this type of client, we want to talk to you about some of the things that might be beneficial to you as far as the way that you approach sitting down with those clients. And we think that we've got some good insight in that as to help you get in front of more of these clients. Obviously, the more of these clients that you get in front of, the more opportunities that we both have, for annuity sales and for assets under management. Then you make the introduction to the client. In the frequently asked questions section, one of the questions that come up, we can open accounts for clients strictly online. We can set the account up. We can send them the documentation. They can e-sign that documentation. There is not one single piece of paper that has to go back and forth, and get the account completely set up and be totally authorized. So that's all that I had today, just kind of a quick walkthrough. I think if you want to read through that frequently asked question PDF that's attached, there's certainly more questions and answers, more of the detail. But if you're interested, I'll turn it back over to Rick.
Thanks for that presentation. That was great. I've been monitoring. We've had several questions come in. Maybe we'll get a chance to address a couple of them that seem to be reoccurring a little bit. It does seem, in response to your prompt, most of the folks on board today were really not aware of this kind of agreement with a solicitation agreement allowing somebody without or not operating on a securities license to solicit business and generate interest and basically refer it over to you. That seems like it's a new concept for most of the folks on today.
Rick, let me, if I could elaborate on that a little bit further. You know this, but I didn't share this in the presentation. But in my office here in Indianapolis, we office with one of the biggest securities litigation firms in the country. And the managing partner of that firm is a former commissioner of securities here in Indiana. They're very visible nationwide. They've gotten, the biggest individual award for individual investors. They have a judgment against the Wolf of Wall Street firm, Stratton Oakmont, for $13 million. We've got clients that are Madoff clients. I say that because they are under a solicitation agreement with us. So that law firm has been, we've worked with them for about 15 years, and they've been under a solicitation agreement for 15 years. We've had numerous audits, and it's never been an issue. In fact, when we originally started that solicitation agreement 15 years ago, I was an independent branch manager for Raymond James. And Raymond James had a program that they called the Professional Partners Program that was under this solicitation ruling. So it was a process that Raymond James allowed, but it was, again, strictly on the RIA side, strictly on the fee-based side, not on the broker-dealer side. There is no capability to share commissions, securities commissions, and we want to be very careful that we don't do that. What we do is we don't do any business in commissions. So all of the work that we do is on a fee basis on the securities management. So we don't ever have to run into those issues with the broker-dealer.
Okay, and along those lines, we've had a number of people with questions pertaining to the Department of Labor and the new rules coming out of there. I know you touched on that a little bit, but if there's anything you can add to that, the fiduciary arrangement that we're getting a lot of scares coming our way on the independent life and annuity side. If you can touch on that a little bit more, if you have anything to add.
Yeah, I think it's a very disturbing, very frightening situation, and top-level view to say that everybody's going to be held to a fiduciary standard, which in the RIA community, we've been held to that standard from day one. The other standard that the broker-dealer community is held to is what they call the suitability standard. The suitability standard is a far more lax measurement to say, is this product suitable to be sold to this client? Whereas the fiduciary standard says that we're never going to recommend anything to our clients that are not in our client's best interest. So it's much, much higher standard. So you would think that the RIA community would say, this is fantastic, that now the broker-dealer community is now going to be held to this fiduciary standard. The problem is in the detail of what that regulation is. And I think that it's so encompassing that it's very likely that the thing will be challenged and diluted and overturned potentially. But as it is, it's a very, very disturbing rule. And one of the things that I haven't seen a lot of people talk about is the penalty for this, for violating the fiduciary rule or violating the policies and procedures around the fiduciary rule. The Department of Labor has turned this over to the IRS to enforce, and the penalty is 100% excise tax. Mm-hmm. So if you sell an annuity for $100,000 and you don't disclose the fees, or you don't have proper policies and procedures that you can prove to the regulators that you're following on a day-by-day basis, and you won't know if those are approved until somebody takes you to court to prove whether they are or not. Right. There isn't some template that you can get to say, okay, as long as I do this, I'm okay. The fee, if you're deemed to have violated, is a $100,000 fine that you pay to the IRS, not to the client. So it's an absurd rule. But, having said that, as frightening as it is, and I think at the very least what we'll see is a lot of the insurance companies will more than likely adjust some of their compensation so that you see more of a level compensation strategy rather than upfront commissions, because it's all going to have to be disclosed now. But at the end of the day, I think that this could be a huge advantage.
Yeah, so that's a tangled mess, and at this point, we're all just kind of speculating exactly when it'll be implemented, if it will be fully implemented, and so really, I know NAFA, I know a lot of the organizations that on the fixed side we work with. They've been doing their best to give us guidance and predict where we'll be a year from now when this starts to get implemented. But I really don't think anybody knows exactly how it's going to shape up.
Yeah, I agree. I think that as it stands right now, it's very disturbing, but it's so disturbing that I think there's a very good chance that it gets reworked.
Right. Okay. Yeah, I'm looking through a few more of the questions. We have state availability questions. I think you can pretty well address that as far as the solicitation agreement pretty quickly here.
The regulation is a federal regulation. It's the Advisors Act, so it's an SEC rule, and I have not seen any states that have taken a different stance than that. There are state by state, there are CPAs, for example, that have some restrictions, but that's because of the CPA Society, not because of the SEC.
Okay, so generally, everybody on today's webinar, this is going to generally be available in your state. If you have particular questions, if you think your state may have some extra hindrance for you, we will go ahead and get you guidance on that. I see a few more questions getting typed here. We're going to try to probably get wrapped up pretty quick. So the one other thing that I think you did hit pretty well, Tony, but could we clarify a little bit, maybe even go back to the slide on the compensation and how that works, maybe hit that again a little bit here?
What we're proposing is through this arrangement, take, for example, in year one, if you referred assets of $3 million, then depending on the account size, our maximum fee is 1.5% on accounts up to $500,000. From $500,000 to $1 million, it's 1.25%. For accounts from $1 million to $2 million, it's 1%. So this would be a number of accounts that would be under $500,000 that would total $3 million. So if that's the case, then the fee would be 1.5%. So the total fee for the year would be $45,000. The referral fee to the agent would be $15,000. And the next year, if they add another $3 million, the second year, then the fees would be another $15,000 on the additional $3 million, but you would also have some growth on the original $3 million. So as this annuity grows for the agent, as the account values grow, as they increase in value, as people add more money to them, the revenue to the agent will consistently go up. Now, once people reach retirement and they're starting to withdraw money on a regular basis, it may be a little bit harder to keep pace with that distribution rate. But we also have a lot of clients that are not in retirement that are adding pretty significant money year over year. Doctors, for example, have a capacity to put considerable amounts of money into their 401k plans and pension plans. So, year over year, the growth rate tends to run pretty significant because, as I said, our average return is just under 10%. But what we find is that net of the return, people typically, at the end of the day, net add money. Even though some people are taking money out, there are still some people that are putting money back. So, right. If and this has no bearing on what you're doing on the insurance side, what your production is on the insurance side. If you're looking at, targeting retirement in 5 years, you could look at this income that will keep on going as long as the client is still with us. Obviously, when the clients leave us, we don't have the ability to generate that fee to share with the agent any longer.
As far as what it takes to get started in this program, a number of people on the webinar today are contracted with SilverSide, maybe for one of our annuity carriers, one of our life carriers. The agreement to get started here would be totally separate from that. It would be a solicitation agreement to solicit on behalf of AMS. and we can get that out to you. It's got your typical legalese in that kind of agreement, and you can go ahead and review that, have your attorney take a look at it if you like, or we can get you in touch with Tony if you want to clarify any of the high points or any of the details on that for that matter. Anything to add is how they would get started with a solicitation agreement if they're existing life and annuity producers contracted with several life insurance companies. Anything to add to that, Tony?
Yeah, I think, the agreement's pretty simple. It just kind of sets out, what we pay, how we pay it. We pay on a quarterly basis after the end of each calendar quarter. You can set it up so that, the payment is direct deposited into your bank account. But the agreement's pretty simple, sets out the terms between the two of us. It does have some verbiage in there that you won't represent yourself as a registered representative. You won't represent yourself as the money manager. Those are the only things you really want to be careful not to present yourself to the client. But I think it's been my experience in working collaboratively with attorneys and CPAs my entire life that the client is actually relieved that there is this network of trust. Otherwise, it's just them. All of the evaluation, all the due diligence is 100% on them. If they're sitting down with an agent or have had a relationship with an agent for many years, they obviously trust that agent. So they're relieved when the agent says, well, I have a solution for some of your other problems, for some of your other assets. We have been asked this question often enough, felt like we needed to find a solution for our clients, and here's what we came up with. And we felt so strongly about it that we entered into an agreement where we actually share some of the fees. So we're all in this together. And I think that's a relief to the client to know that, they're not paying any more for the agent to be partially compensated for that, and they like the idea that the agent, who they already know and trust, is in the loop.
Right, and from a presentation standpoint, if I'm an agent, I'm out in the field, I'm doing a account review with one of my clients, or I'm doing a fact finding with a new client, and I see I discover what their assets are, what their liquid assets are, and kind of what their planning expectations, or what they want to do as far as retirement income, as far as leaving a legacy to their kids, grandkids, whatever. While I'm in that process, how would I interface with AMS or with you on what we might recommend as far as a managed money portion, and maybe in annuity, or even for a legacy, maybe a life insurance contract? How would I interface with AMS while I was in that process?
Well, I think the agent has to do some evaluation to what the needs of the client are. I mean, if the client has a estate planning need, then obviously they want to address the insurance solutions to talk to those points. If they have an aversion to risk, probably the major drawback that clients have to index annuities are the liquidity. And if people are reluctant to put money where they can't get to 100% of it within a matter of days with no surrender charge, I think this is the next best solution. I mean, if the client wants help in that regard, we're happy to, reinforce the recommendations. Our function is not to persuade these clients to do something other than an insurance product or other than an annuity. As soon as we did that, we would ruin that relationship with the agent. So we'll be very careful to make sure that we respect that these clients or these relationships are the agents, not ours. Let's say that somebody comes to us and they have an account with us, and they've got $500,000 in a managed account with us, and a year or two or three down the road, they're looking at the managed account, they're looking at the performance, and they say, I'm making as much money, or I'm making more money in my index annuity, or I'm not making as much money in my index annuity, but I like it because I don't have to worry about it. I think I'm just going to put all my money in the index annuity. We would absolutely not stand in the way of that conversation.
So as you're interfacing with me as an agent, designing solutions for my client, or designing you and I might have the conversation. Hey, well, maybe they need to have X percentage in a managed account with these expectations, and maybe they need to take, if they want to leave a legacy to their kids or grandkids and their health is good and they're insurable, maybe they do a single premium whole life or do a no-lapse universal life or something to generate some tax-free death benefit. That might be part of the solution. Part of the solution might be an income annuity or an annuity for accumulation without any market risk. So you and I might get together and design a multi-tiered solution with what the fact finding disclosed as what the assets they have available and what they're looking to do with them.
Absolutely. I think that, you as a resource, and I hope that they would look to us as a resource, to fortify that presentation. I just want to make sure that we're available to help in any regard that they ask, but our function is really not to step over them to say, well, we're going to take over and we're going to do this full financial plan, and we're going to look at everything and scrutinize everything that you've done. We're available to help if the agent asks,
okay.
and we want to be seen as a resource to the agent, but in no way do we want to interfere with what the agent recommendation. The other thing I think that, we didn't really detail in this, but if somebody has, some agents have been referring business to other advisors for years and not getting any compensation on it, this is a way for them to get compensation. But if they haven't, if they just haven't had a solution for those people that, wanted to have money in the market, that they needed to have money that was liquid, now they have a way to offer that to their clients. But they may also look at their existing book of business that they have built up over the years with the assets that they currently have in annuity. You could go back and do kind of a dollar cost averaging out of the existing pool of annuities that you have that you may not have been paid on for years, and say, let's take a 10% free withdrawal, let's move it over into this managed account and transition some of that money so that you could build this up over the years.
There's plenty of options available in this. I think for a lot of guys, and judging from the questions I'm getting here, it's food for thought. I think it's a new way of looking at managing client relationships, and it's a new resource. It's a new piece that a lot of guys are going to be able to add. Again, without all the headaches and hassles of going to get licensed. If you're going to be registered RIA, all the compliance and all the document record keeping and all those things that you're going to be responsible for. This is a way for guys who aren't involved in that to be able to expand their offering without getting directly involved in that.
I agree. I think it's, we're in a world of specialists, and, you have to be really good at what you do. And I think part of that is recognizing the things that you don't want to devote your time to, or you don't have time to devote to, and say, I'm leaving money on the table here. And I think that I can see better clients. I can see bigger clients. I think that, life would look a lot better each year if you knew that you had this recurring income stream starting January 1st every year. It puts a lot less pressure on you to have to continually go out and beat the bushes to find new clients. So I think it's a win-win-win situation, and I think that I'm not sure that the agents can fully appreciate what this looks like from a collaborative effect to the client. The ability to say, we have a solution for your liquid money, and capture those assets and be compensated on those assets.
Okay, well, we're going to go ahead and wrap up here. I want to thank everybody for being with us. For immediate information on how the solicitation agreement works, or to take a look at a solicitation agreement, go ahead and give us a call. Same number, 480-998-1286. We'll get you the follow-up information you need, and we will get you in touch with Tony and AMS for more details. So with that, I'm going to go ahead and thank Tony for being with us today, and we'll get this thing wrapped up. And thank you all for your time this morning.
My pleasure. Thank you, Rick.